I'm going to park the piece on inflation and I'll ask Mr. Louis Chigundu, because over the last 18 years or so, corporates have deemed that it's cheaper to borrow in dollars. So you've got UGX receivables, but for some reason, because the dollar is looking like, I don't know, 2% plus maybe a margin of 3, all in at 5%, compared to Uganda shillings, it looks like it's cheaper, obviously before you now begin to adjust for inflation and exchange rate and all. We've now seen a shift because dollar rates are as high, benchmark, is as high as about 5.3%. Do you really think it's still, in your opinion, is it still cheaper to borrow in dollars or shillings, or what are some of the considerations corporates would take to arrive at a decision on what currency to borrow in?
Okay, thanks, Daisy. Morning, everybody. I think from a business perspective, generally, the interest rates you get on dollars are cheaper. So it will be cheaper or lower. So it will be cheaper for you to borrow in dollars. Now, if you're in a market where your currency is devaluing at a very fast rate versus the dollar, that could be very expensive for you. But for Uganda specifically, the UGX has been relatively stable versus the dollar, versus if you look at some of its neighboring countries. Everyone can hear me, right? Yeah. Versus some of its neighboring countries. So you could sort of bank on the fact that what you get in dollars from your shilling would be relatively stable. So your input costs wouldn't really go up. Now, in countries where your currency is devaluing very fast, I mean, the cost of your inputs would increase. So you'd buy, for example, let's say if the shilling was at 3,700 to the dollar, today your inputs you're importing them in dollars. So you buy at 3,700. Let's say you have payment terms with your supplier, you have to pay him in a month, and all of a sudden the shilling's at 3,900. You've already lost 200 shillings to the dollar. So your input costs are going to go on. Now, in an industry like us, where we are in the oil and in the downstream business, you'll find that would be passed on to the consumer. Because at the end of the day, you're also trying to ensure that you're running a profitable business. So at the end of the day, the man on the street, the end consumer, would take that pinch in his pocket. And as my fellow panelists said, inflation is going up, and oil inputs are really a driver of inflation, and they reduce economic activity. So from our perspective, borrowing in dollars has allowed us to be a little more competitive in terms of our inputs and keeping our cost of goods at a relatively stable area. So I think it really depends on how your currency is trading. But in our case, generally, borrowing in dollars has been cheaper than borrowing in shillings.
Okay. David, I'm going to come back to you because I want you to shed some light on how long and how sustainable the tight liquidity conditions are, how long we expect, for example, so far at above 5%, because then that's also a consideration in terms of what actually is cheap from a borrowing perspective.
Yeah, on that front, I think I'll rely on the key benchmark, which is the federal funds governors dot plots. So it shows projections of where they expect interest rates to be. If you look at their projections into 2024, 2025, you're looking at about 3.5% interest rate level of the 5.5% where we are. So that's about 200 basis points reduction in rates, but it also goes to show that they still expect inflation to be above their target, which of course is unrealistic at the moment. But I think for me, that's the trend. You have a reduction of 200 basis points, but does that translate faster into the rest of the world is becoming a trick, because you have to consider where growth is coming from, how the geopolitics evolution turns around, and the like. So there's going to be a lot of moving parts between Europe and the US, and which one, if they grow out of this dip at the same pace, then perhaps rates come down lower. If there's a difference between Europe and the US, then you find that there will be challenges and disparities around where the true pricing of dollar liquidity will be. The standard best rate is really your central bank rate. So it's central bank rate, then liquidity, and then credit, and then inflation. So that's the several layers that feed into pricing of UGX rates. So right now, if you get the monetary policy side, and then you look at the fiscal policy side, as Daisy mentioned, is fiscal consolidation going to come, which will mean supply of treasury bills and bonds. So as we know, government financing is a direct competition to private sector financing. And that discussion has been held at several budget readings of we're going to reduce domestic borrowing needs to allow the private sector to flourish. What we are seeing is that yes, there was a reduction in the financing need for this calendar year, but it could get increased next year or the following year or even interim. And that will create a supply factor in terms of what other assets are available for investors or the guys who have cash to look at as opposed to business, right? So I think that's another side that we need to look at. I think right now, as we see, there's been a lot more. If you look at the treasury bill results in the newspapers, you'll find that for 2 auctions in a row, the acceptance rate has been more than the targeted amount or the initial amount that was targeted in the market. And that has kept your 6 months and 1 year treasury bills high. So if that proceeds into the next few months, then we see elevated levels, interest rate levels for a much longer period, and potentially maybe we see the reduction coming to second half of next year after we've seen that clarity in the fiscal needs.
I think, yes, you're right. There has been divergence in terms of the interest rate outlook. As you notice, the developed countries are taking a more hawkish tone. And recently, Bank of Uganda took a position to contract, to reduce on the CBR. And the reason was mainly driven by the improving inflationary environment. When you look at the inflation that we had October last year, and the numbers that came out, they are really, really down. And that necessitated. So it was mainly driven by the macroeconomic factors prevailing. And that was the motivation. As you're well aware, our objective is to create an attractive pricing environment. And given the fact that it's kind of idiosyncratic, our macroeconomic indicators were pointing down, improving. So there was necessity to cut the rates. And that's the spirit. Of course, there are risks going forward from the external sector, but on the balance of risks, it was important that we cut much. I think high inflations usually translate into undesired depreciated exchange rate, which at the end of the day impacts on the pricing. And this is where now the Bank of Uganda comes in to kind of manage the spikes that surround the exchange rate. We've done a lot of effort in this area to ensure exchange rate stability, and as you can see, I think our rate in the region has been fairly stable. And we are glad on that, basically because of your participation and our participation in terms of the policy issues that we've laid down, the issues of the liquidity challenges and how we manage liquidity out there to kind of direct the stability in the exchange rate that we are seeing right now.
He's rightly put it. So there is the FX component, but then there is the oil prices component. As you mentioned at the start, oil prices have touched 97 in the last few days, and there are calls for it to touch 100 again. So that becomes critical because in our basket of inflation, aside from food, you have that fuel component that is critical. And then you must notice that there are the uncontrollable factors. Weather. We are currently in an El Nino period. So how that plays out will become critical to the inflation outlook. Right now, just looking at the inflation outlook on base effects, not factoring in any additional price movements, you see inflation averaging around 2.5%, 3% into the next 6 to 9 months. But El Nino becomes critical, especially in the regions that are producing food, as well as the transport sector, because transport becomes a critical component over and above the fuel aspect.
I think one of the risks on the exchange rate, as you may all know, especially in our economy here, are the foreign offshore flows. This is a very big risk. Added to this is the noise that we normally get from the developed countries, which kind of trades in our trade here. So what the central bank has done is to provide a conducive environment that minimizes flight to quality. The risk of sentiments as perceived by the foreign portfolio flows, we've tried to stabilize that, trying to ensure that we create an attractive environment that continuously and consistently attract portfolio flows to Uganda. And this, I think, when you compare with the region, that's the reason why you see most of the portfolio flows right now are flowing into Uganda, because of the attractiveness, the openness, and the will and the desire to intervene at any one time when it's appropriate. The central bank is ready, it's very transparent, and this message has sent confidence to the foreign portfolio flows out there that yes, when you compare in the region, I think Uganda for now is providing a favorable environment. So we see more offshore flows coming in. So our duty here is to provide the environment. We've provided tax reliefs in terms of the government securities market on the longer side of the end to attract portfolio flows, to create kind of a carry trade that is positive for the offshore flows. So this, along with our openness and confidence and working with you in the many aspects of ensuring stability in the exchange rate, has made it very attractive.
We take a very risk-averse approach. We look at hedging our risks so that we know today if we need X amount of dollars, we'll hedge that, and we'll know that in 3 months when we need to pay this liability, we'll know how much exactly we're paying at that time. So there's no risk of the shilling devaluing in maybe Q4, as has been mentioned, and then having to pay out more shillings than you initially anticipated, which could, in our field, where you have very thin margins, could have a big impact on your overall financial performance. I think in that aspect, you can try and curb that risk, but I think the shilling has also been very, very stable. That you could, if you really wanted to take the risk, you could play with it and you wouldn't really get hit very hard. I think in the Namibian market where I was before, it was a completely different scenario. The Namibian dollar is linked to the rand, and the depreciation there was extremely, fluctuation in the rand versus the dollar was very volatile. Now, in a space where all your inputs are basically dollar denominated, you're going to get hit hard. So one morning you go to bed, you're trading at X amount, you wake up, you've lost 25%. And if you haven't already planned for that through different, hedging approaches, your financial results will be hit hard. And I'm talking about big dollar amounts. So it really depends on the market where you are, the approach you take, how risk averse you are, and what your end goal is. From our side, we don't like to gamble, so usually we like to know exactly what we are paying for so that we can ultimately price appropriately. But also on the flip side, those losses in a deregulated market like Uganda usually will be passed on to the end consumer, as I said before. So if we're reckless and we make big foreign exchange losses, you will see it in the pump prices. And the opposite also holds. If we get the gains, usually you'll see it in the pump prices going down. But sometimes
Hedging is putting in place risk management solutions to ensure the future viability of your business. Speculation is taking a view on the market in whatever currency or whatever asset class that you are involved in to make a gain. Hence, you hear words like winning or losing when you're referring to speculation, gains and losses, beating the market, losing to the market. That's not what hedging is. Hedging is putting in place solutions that provide certainty or that provide protection. And I'm very pleased actually to have the regulator in the room. And I must say, it's one of the first countries I've been to that the regulator is supportive of hedging. Typically, the regulators are also on the side of believing that hedging is dangerous for the market. So it's very welcoming to hear the regulator encouraging hedging, not speculation. And that's why we're here. So naturally, it's human nature. If you hedge and at a later stage the market is below the level you've hedged, a situation like yourselves where you're borrowing, you're naturally going to think, I have lost, or the market has beaten me, or I could have gained. Again, you have moved from hedging to speculation. So it's a mindset. We need to start getting into the mindset of hedging as opposed to speculation. It's human nature. If you go and you buy a car, you buy a house, the house price goes down, you're going to wish you waited. If it goes up, you're going to say, great, I bought it at the best time. But you must bring all of this back to hedging and what is your forecast. Your daily business, the operations, do not, your business, your core business is not hedging. Your core business is not FX management. Your core business is not interest rate risk management. Your core business incorporates FX because it's something that you need to manage in order to ensure that your business continues to be a going concern. And that's where we are. That's why we're here to help. So if we work together to put in place solutions that allow you to go to bed at night knowing that you don't have to worry about FX risk or interest rate risk, then from your perspective, you can concentrate a lot more on your core business. Because currently what's happening is you're spending time daily calling the banks. Where's the FX rate? Okay, it's high, it's low, I'm going to wait till tomorrow. That's not your core business. That shouldn't be your headache. All you should be worrying about is, where is the rate versus my forecast? So if you're in the spot market, then you're having to manage FX on a daily basis. However, at the start of each financial year, you have forecasts and a budget rate, whether it's monthly, quarterly, semi-annually, annually, maybe 2 years, 5 years. You have projections, you have forecasts, you have budget rates. That's what you should be targeting to manage. So if you can put in place a solution that allows you to manage that risk, if you can get an FX level that's better than that budget rate, from your perspective, you can go back to your core operations. Again, naturally, as human beings, and because it's something we've always done, you're going to check the rate you've hedged versus where the market is. But what you should actually be comparing is, where have I hedged versus where is my budget rate? Because that's what guarantees the future viability of your business. To give you a practical example, if your budget for this year is 4,000 and you can hedge at 3,800, even for the whole year, even though the market is lower than that, it makes logical sense, because if the market never gets to 4,000, you've hedged below your forecast, your budget rate, your business is viable. If the market never gets to 3,800 and you remain in the hedging mindset, you're still fine because you've beaten your budget and your forecast. If the market goes above 3,800, you've still beaten your budget forecast. You've still beaten your company is still viable, but you should still try and remain in the hedging mindset, as opposed to then saying, I've beaten the market, so I want to do more hedges, because then you're going into speculation, right? It's a difficult mindset to have, but that's how you have to think.